Most traders don't lose money after entering a trade. They lose money before they even place the trade. The decision that leads to the loss happens long before the market does anything to them. Every time a trader hesitates, feels nervous, feels greedy, or feels pressure to take action, the brain is silently pushing them into a bad decision. And this happens so subtly that the trader doesn't even recognize it. So welcome back to Wealth Mama. Today, we're going to break down the psychological reason behind why most traders lose. And friends, I'm going to give you a small mental experiment that will make you see how your brain often beats your strategy even before you open a position. Section 1. The experiment. Let's begin with a simple scenario. Imagine you're looking at a chart right after the market opens. Suddenly the stock jumps 2%, then 3%, then 4% in just a couple of minutes. The candles look strong. Volume is high. The chart feels alive. At that exact moment, your mind creates a sense of urgency. You start thinking, if I don't enter right now, I'll miss the entire move. Your heart rate increases slightly. Your fingers move closer to the mouse. You start feeling like entering is the only logical option. But the truth is, nothing logical is happening here. This entire reaction is triggered by a chemical in your brain called dopamine. Dopamine is released not when you make money, but when you think you might make money. It's the maybe I'll get rewarded feeling that creates excitement. That excitement looks like confidence, but it's actually impulsiveness disguised as opportunity. And friends, this is where most losing trades start, not in the chart, but in the brain. Section 2. The brain was not designed for trading. The biggest misunderstanding traders have is believing that they make decisions logically. But the human brain was never designed for trading. It was designed for survival. When we see sudden movement, our brain treats it the same way it would treat danger or opportunity thousands of years ago. Our survival instincts kick in, not our analytical skills. There are 3 major psychological limitations that make trading extremely difficult for humans. Limitation 1. The brain experiences loss twice as painful as profit. When you lose 1 rupee, the emotional pain is twice as strong as the pleasure you feel when you gain 1 rupee. This is why traders cannot tolerate small stop losses but easily book small profits. The brain simply hates losing so much that it makes you close winning trades too early, just to secure something. And it makes you hold losing trades much longer, hoping the loss will magically disappear. Limitation 2. The brain wants immediate reward. The mind loves instant gratification. Trading gives the illusion of quick reward. You can press a button and potentially make money within seconds. Because of this, traders often enter without waiting for confirmation, chase fast moves, and overtrade multiple times a day. It's not because they lack discipline. It's because the brain craves the quick thrill of taking action. Limitation 3. The brain makes emotional decisions before logical ones. Humans react emotionally first and logically second. Fear, greed, hope, panic, and excitement rise instantly. Analysis comes later. In trading, by the time logic tries to intervene, the emotional decision is already made. This is why traders often say, I knew what I was supposed to do, but I still didn't do it. And guys, this is how the brain quietly sabotages trades without the trader noticing. Section 3. The psychological loop of losing traders. Most traders go through a predictable psychological cycle every time they place trades, and this cycle repeats until the account is destroyed. It usually starts with an impulsive entry. The trader enters too early or without confirmation because the setup felt right at that moment. Once the trade is taken, the trader enters the hope phase, where they convince themselves that the market will move in their favor. If the trade goes slightly against them, fear kicks in. The trader starts doubting their decision, but instead of exiting, they continue hoping it will reverse. When the loss becomes difficult to handle, panic takes over, and the trader exits at the worst possible moment. The price often reverses immediately after that, making the trader feel regret. That regret leads to a revenge trade. The trader wants to instantly recover the loss, so they take another trade without analysis. This revenge trade usually results in a bigger loss, which leads to frustration and eventually self-blame. Friends, this loop is extremely dangerous because once the brain gets used to this cycle, it becomes a habit. And once it becomes a habit, breaking it feels almost impossible. Section 4. A real story. I once knew a trader who had a very strong strategy. His backtests were perfect. His win rate was excellent on paper. He had clear rules for entry, exit, and stop loss. But in real trading, he kept losing consistently. One day I asked him, "Why did you enter this particular trade?" He looked at the chart for a moment and said, "It just felt good. It looked like a strong move." That was the problem. He wasn't entering based on rules. He was entering based on emotions disguised as intuition. Many traders mistake emotional comfort for logical confidence. They think they're following the setup, but they're actually following a feeling. And guys, feelings don't have risk management. Section 5. The science behind failure. There is strong scientific evidence showing that most trading mistakes are emotional, not technical. Research shows that nearly 80% of trading errors come from emotional decisions, not from wrong analysis. The human brain actually has two systems. System 1 is the emotional, fast, impulsive side. System 2 is the logical, slow, and analytical side. System 1 makes you chase candles, skip stop losses, average losing trades, and exit winners early. System 2 wants to follow rules, stay disciplined, and trade based on analysis. But in high-stress situations, System 1 acts first. System 2 only reacts afterward. And bro, when a fast, emotional brain operates in a slow, analytical environment like trading, losses are guaranteed. Section 6. The solution. Now that we understand the root problem, let's focus on 3 simple solutions that can immediately change your trading behavior. 1. Ask, is this a setup or a feeling? If the trade is based on excitement, fear, or impulse, skip it. If it's based on clear rules, take it. 2. The 10-second pause. Before pressing buy or sell, pause for 10 seconds. This one pause gives your logical brain time to override the emotional reaction. 3. The why test. Before taking any trade, answer. Why am I entering? What will make me exit? What emotion am I feeling right now? If your answers are unclear, your decision is emotional, not analytical. And friends, emotional decisions are the root cause of most trading losses. This is just the first video in our behavioral finance series. Understanding why most traders lose is the foundation. But now we need to talk about the biggest psychological trigger that destroys traders every day. FOMO, fear of missing out. In the next video, we'll expose how FOMO manipulates your mind, how it forces bad entries, and how to kill FOMO permanently. Let's continue this journey together, bro. Make sure you like the video so it will reach the people who are losing, and subscribe to Wealth Mama so you will stay updated. Also check out the other playlists and videos as the content is going to be awesome.